vamos a hablar de esto del Banco Central Europeo, de inversión, de bonos, con Alliance Berstein. Hoy tenemos a Arnaud Mounier, que es jefe de desarrollo de renta fija en Alliance Berstein. Arnaud, good afternoon. Thank you so much for joining here in Negocios Televisión.
Thank you for having me.
What do you think about the market reaction following the European elections, and especially in France?
Well, I guess no surprise, the market reaction was negative when it comes to fixed income. Now we are seeing that the yields on French government bond is 75 basis points higher than the yield that you would pay on German government bonds. And it reflects the additional risk premium that investors want to get for this type of investments. Now, French banks are also trading generally wider post-election, even though it seems to normalize. I think it's important to understand the reaction of the market, to remember that France is already at risk of fixing an excessive deficit procedure from the European Commission. And some pundits have already drawn a parallel between what happened to Liz Truss and our aggressive economic plan in the UK and what could be the market reaction should a populist party, either right or left, win the election in France. So we think the likelihood of a similar situation as what happened in the UK is low because France is part of the Eurozone with the benefit of a common central bank that can act to avoid excessive volatility in the market. That being said, it's completely possible that French government bonds could trade with the same type of yield level as, for instance, Spanish government bonds.
Mm-hmm. A few days before the European elections, Arnaud, the ECB delivered a first rate cut, a widely expected rate cut by the market. What should we expect from now on? Because the ECB hasn't been really specific about what the trajectory of interest rates will be here in Europe.
Yes, absolutely. So, well, the cut was completely expected by the market, so there was no really reaction as a result of that. If there had been no cut, that would have created significant volatility. So I think here that was the good news. No surprise is good news. I think the question, as you mentioned, is no longer cut or no cut. Is more the question is when is the next cut? And because the ECB is going to be very careful about talking about next cut until they see more progress on data, on inflation data, we do expect rate cut to happen on a quarterly basis, probably in September and December, after the ECB has been able to collect more data, especially on wages. So basically, we expect 2 more rate cuts in 2024. It's quite consistent with what the market is pricing at the moment. That said, let's be clear, we do expect market volatility for interest rates to remain pretty high. And because we will see each time there is a new CPI or inflation print, the market might be disappointed or pleasantly surprised. So inflation is here to volatility is here to stay, but we do expect a couple of rate cuts before year-end by the ECB.
Mm-hmm. If we're speaking of the US, still there's no sign of an imminent rate cut, and interest rates volatility remains fairly high there in the US. What are the implications in terms of allocation to fixed income?
Well, to be fair, this has made fixed income allocation much more challenging to establish and markets to navigate. When we compare with the initial expectation when we started this year of 5-6 rate cuts by the Fed, now the market and even us are pricing maybe only 1 rate cut by the end of 2024, at the end of this year. So the case for increasing your duration, especially duration in the US, is not very clear at the moment. What we tell our client and what we do in our portfolios is really to have a neutral to slightly underweight position for US duration. And we prefer to take more duration risk in other countries where the rate cut cycle has begun or is about to begin. And so those are countries like Canada, like Europe, like UK, and some EM countries like Brazil, for instance.
In this context, what would you try to say to investors who prefer to leave cash in bank deposits or short-term investment products, for example?
Mm-hmm. Well, I would say first that I understand why they do that. It makes sense at the moment, given the challenge performance in fixed income. But more seriously, I think when markets are exhibiting volatility as they do now, it's really important to consider your investment horizon. And if it's longer than 12 months, longer than 18 months, I think there is still a very high probability that interest rates levels are going to be lower than what they are now. Inflation is normalizing. Growth forecasts are not very exciting in the context of geopolitical tension. So we remain confident that interest rates will be lower 12 months from now. So the point is, because there's so much cash waiting on the sideline, it's better to act sooner and not to wait until these rate cuts do happen. And I think when you look at the valuations, for instance, on corporate bonds, on quality assets, it's very important not to wait too long. If you take a broader context, if investors have assets in their portfolio like equities, we do think that duration can play an interesting role in balancing your risk. You will see duration acting as a good hedge in case of potential market correction in your portfolio. So we do advocate for longer-term investors to increase duration at this juncture. Thank you.
Arnaud Mounier, Jefe de Desarrollo de Negocio de Renta Fija en Alliance Berstein. It's been a pleasure to have you here, Arnaud. Thank you so much for joining.
Thank you.